Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another edition of Real Estate 360 Live. For those of you not familiar with our weekly podcast, we do a weekly podcast each and every week. It can be found on iTunes. If you search Real Estate 360 in the search bar, you'll find it. You can subscribe and download our weekly podcast there. Many people have been doing that over the last couple of months. And also, if you don't have access to iTunes for some reason, you can also go directly to the website and stream it there at realestate360live.com. That's realestate360live.com. You can also ask any questions that you have, anything that you'd like us to cover on future episodes. We'll be glad to cover that. For those of you that this is the first time listening to our podcast, like I said, it is a weekly podcast, and we cover everything from interest rates to the economy to what's happening in Washington, what's going on with the Federal Reserve, as we're going to cover today in Janet Yellen, the Fed chairman's statement. Obviously, they continue to taper, but they also used language that was quite interesting, which kind of upset the market. So we're going to talk about things more on a national scale, but we're going to narrow it down a little bit in metropolitan areas at times. But we're also going to let you know how it's going to affect you in your real estate decisions. Most of the time you're relying on, these huge sites, National Association of Realtors, Zillow, these big national companies that are pumping out this news, which doesn't necessarily give you the best view of what's actually taking place in the markets. And it's kind of our job each and every week to kind of break things down on a more elementary level. And hopefully you guys have a lot to gain from the information that's here, other than just, hey, interest rates are going up and interest rates are going down. So joining me on our panel, as he does each and every week, is Louis Camerosano, who is a former school teacher, former attorney, and a former general manager of a major real estate portal. Louis has been cited in the media as a real estate industry expert, cited in the Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, Smart Money, and numerous others. Louis, how are you doing today?
Splendid. How are you?
I'm doing well, sir. Good to have you back on. So, we've had this is one of those big weeks. Each and every week we do find ourselves talking about the Fed for one reason or another, but that's mainly because, they are, to me, the only one in control of this economy at this point. They like to blame Congress that the pitfalls of the economy are due to, fiscal restraints that they're setting forth. But really, the Fed was supposed to be the one that was going to be able to print all this money out of thin air, and it was going to fix the employment situation. It was going to have the inflation level heading towards where they wanted. And as we know, those things have not been the case. The only people that have benefited from this is the big banks, the hedge funds, the huge conglomerates that have access to cheap money. So when Janet Yellen came out and gave her policy statement, basically, they've now reduced the purchases of agency mortgage-backed securities at a pace of $25 billion per month rather than 30. So they cut that by $5 billion, and they're going to also add to its holdings of long-term Treasury securities at a pace of $30 billion versus 35. So they cut that by $5 billion. So that's a $10 billion cut, which, as we talk about all the time, Louis. It's a cut, but it's still $55 billion per month out there. Right? So they're moving in a direction of they're trying to remain more consistent. What was interesting about the policy statement that in Yellen's testimony was that she said that, with the added the labor market participation rate was increasing, the continued economic improvement in the labor market will increase, the employment sector is not close to full employment, and that she's going to drop the 6.5% unemployment target, which was what the policy statement had indicated, because it was not effective. Now, my question to you, Louis, is why was that 6.5% unemployment target ineffective?
Well, the 6.5 unemployment target is ineffective because, as you know, it's been going down as people leave the labor force. They're well aware of that. They've made reference to it in the past that the unemployment rate doesn't necessarily reflect the health of the labor markets, and that they need to look at other factors. Indeed, the Federal Reserve of New York under Dudley has come up with some quite more sensible ways of looking at the labor market that include things that go beyond the unemployment rate. They look at the number of hours worked, the labor demand. They do look now at the labor force participation rate, the number of job losses, what wages are doing, labor market mismatches. So they probably were looking at them all along, but they probably had plugged into their formula just the unemployment rate, which is a mistake because the unemployment rate is riddled with misreads on the health of the economy. But what Yellen did yesterday was quite astounding, Ryan, because as you noted, even though she says that the unemployment rate isn't the be-all and end-all, she made it sound like the labor market is doing just grand, and the only problem we have now is we don't have enough inflation. So she overstated the health of the employment market by a wide amount, and of course she understated inflation as if we don't have enough of it.
Right.
So, I think that what she did yesterday was masterful. She comes in, she wants to gain credibility as a hawk, not as a dove, but at the same time she wants to claim everything is going along just fine so that they can go ahead and do this tapering. And as you mentioned, it's still at $55 billion a month. But I think doing this, she gains that credibility we've been talking about that the Fed desperately wants, that they're not just these mad money printers and that they're they see everything is going well and they're going to continue this taper. And they want out of this business. They got $4 trillion. But in the Q&A, she also mentioned that they're going to be reinvesting and rolling over all the securities they already bought. So
right.
as we've talked about in the past, that amounts to $10 billion a month anyway. But that'll probably increase because they're still adding Treasuries and mortgage-backed securities. So even as they taper, the rolling over of the past securities that they've bought probably negates whatever they taper. And they've cut QE in the past before. They've stopped it. They've tapered it. That's why we've had QE 1, 2, 3, 4, infinity, whatever you want to call it. So this is really just a credibility pause into probably having to reverse course when an unexpected event like the labor market, after they look at their new ways of looking at labor, isn't as robust as they thought it was, or they don't see enough inflation, which is possible if certain measures, if the economy doesn't grow and the housing market kind of stops growing in price terms, then they're going to have to look again at what their tapering is and perhaps ratchet up the QE again.
Yeah, and for many people out there that are listening to our podcast right now, and they're saying, okay, so the Fed taper. Now, obviously, everybody saw that mortgage interest rates got a little bit worse by doing that, probably about 0.25% or so.
Yeah.
And this is typically what happens. This is the gut reaction to these statements. Typically, when anytime that they say, we're going to make the taper, that's always going to, in the short term, make interest rates go higher. Now, Louis, what you and I have seen over the last year or so is that even though we're getting those initial spike in rates, they have a way of bringing themselves back down. And I think you brought up the point that they keep reinvesting the monies that they get back in right back into these same securities. So, and
keep in mind that's $4 trillion they've bought over the last 4 or 5 years.
Absolutely, so that's a ton of money, and
they haven't sold any of them.
Right.
That represents an increase, I think, from $800 billion on their balance sheet to now $4 trillion.
Well, and it stands to say that since they still are buying pretty much all of them, 80% of everything that's issued out there, interest rates are probably going to stay in still in somewhat of a tight range. What I really thought was interesting yesterday is really that Wall Street's probably shaking in their boots. They don't like this all of a sudden somebody coming in and being consistent and trying to gain all this credibility and actually. With her statement that she plans on potentially increasing rates. And in
around 6 months is what she said after they finish tapering.
Right, 6 months.
They actually put a time limit on. Normally they just say for a substantial period of time.
Right.
Which means whatever you want it to mean.
Yeah, and very rarely, have we seen the Fed set specific dates, and especially when it's been, with QE and then the actual, the federal fund rate. because obviously, Wall Street doesn't like the fact that the federal fund rate could go up. Then all of a sudden the cheap money starts to disappear. So for them to think that it's the fall of 2015 is interesting. I think that there's absolutely zero chance that it will happen in the fall of 2015 because, as you and I have discussed, Lewis, these indicators that all of the economic data and statistics and everything that we have is not lining up with what's coming out of the mouth of Janet Yellen.
Right, and how can they finish tapering? Because as we've pointed out for years now, when they stop buying, who is going to be the buyer of these treasuries? Because as we know, the government increased the debt ceiling, which means they're going to do more deficit funding of their budget, which means they're going to have to issue more treasuries, which means somebody has to buy them. Well, they're not going to buy them at the rate that the Fed is buying them at this low interest rate. They're going to have to require a much higher interest rate, which the U.S. can't afford to pay. So who's going to buy the treasuries? I don't know. The only possible benefit, Ryan, I think that the Fed gets out of raising interest rates, aside from it makes sense, is if you look at it through the lens that everything they do is to help the banks, not necessarily the government, not necessarily the consumer or to help employment. They have done the banks a huge favor. They bailed them out, and they've taken, for years now, a lot of the bad stuff off of their mortgage, off of their balance sheets by buying up all their mortgage-backed securities. And now, if rates go higher, you've mentioned this before, the banks don't loan money at low rates. Well, if they raise rates now that they've kind of cleaned up their balance sheets for them, now they can get the banks to help them make money by, once their balance sheets are clean and now rates are higher, now they can start lending again and make money via lending. And as you pointed out, well, if people can't afford that, they'll just go to all these new, or not new, but these exotic products like the ARMs and the negative amortization and so on, where they will create a market at higher interest rates to sell mortgages. That's the only thing I can think of why they would want rates to go higher, because the banks would benefit now. They didn't benefit when they were out of money, and but now that they're probably flush because of all the QE, the Fed has bought all their bad debt off of their balance sheets. Now they're ready to let rates go higher. That may harm the government. That may harm the economy. That may harm the consumer. But maybe the Fed's plan is they don't care. They're just trying to help themselves out.
Exactly. I mean, that's the only thing. That's the only logic that really makes sense here. It's interesting. I just pulled up an article. I don't know if it was yesterday. Fortune, finance.fortune.cnn.com. So it was on cnnmoney.com, and it linked over to Fortune. And it said a federal stress test that 29 of the nation's 30 largest banks could survive a severe economic meltdown. I hope they can when they've been bailed out the way that they have. I mean, you know,
they should be in good shape by now.
And I don't know how it's now 30 out of 30 banks with the amount of cheap capital. Why is it 29? And then if you read further, and it goes up to 30 banks tested by the Fed, 29 were deemed strong enough to weather a severe economic meltdown without any assistance from the government. And basically it was saying that if we had like a 50% reduction in the stock market, you know, if bad loans came about, that these banks would still be able to survive without having to rely back on the government for assistance.
So bring it on then. What they're saying is let the stock market crash. Now they're flush with capital. They can buy up all the shares cheap.
Yeah, but you and I both know that this is a joke. They throw out this type of information because ultimately we know that that won't happen and it can't happen. They would not be able to actually sustain, I don't think. With a higher interest rate environment, they would be forced to start lending money again, that would actually be good for the economy. I mean, you know, it's kind of rare that I actually say that, you know, a higher interest rate environment would be good for the economy, but I actually think that small businesses and, you know, people that are entering the workforce, if businesses have access to capital that right now, outside of your big banks, hedge funds, you know what I mean, the ones that are getting the cheap money right now, if you have the smaller businesses, the companies that want to grow, but they can't grow because they don't have access to the capital, well, guess what? If a higher interest rate came about, then these banks would be forced to lend the money in the form of loans. They would probably get out of the stock market, so they'd start lending money to small businesses. They would then be able to grow, maybe hire some employees, and that's not what we have right now.
Same on the housing side, Ryan. If rates were higher, the housing market wouldn't be dominated by investors getting access to cheap capital, regular people will be getting mortgages.
And I've always made the point that people are like, well, fixed rates are going to go up. Yeah, well, that's okay if they go up into the 5s and into the 6s. You know what? There's always been an alternative program like adjustable rate mortgages. Now, I'm not advocating taking out an adjustable rate mortgages, but what I'm going to tell people is that the real estate industry will continue. People buying and selling houses is going to continue one way or the other.
But they're not buying them now. You've mentioned with all these low interest rates, if you don't have access to capital, you don't have access to get the mortgage, you don't qualify, what difference does it make what the mortgage rate is?
Oh, I agree with you 100%. And not only that, because the reason why many of the people that want to buy, Lewis, are these small business owners, right? People that are looking to grow their business, but they can't get a business loan. And if they can't get a business loan, then they sure as heck probably aren't going to be able to qualify for a mortgage loan.
Well, if their business doesn't grow, then how are they going to show the income to buy the home to get the mortgage, to qualify?
Well, I'll tell you how, because there's been all these articles floating around about these 4 million first-time home buyers that want to enter the market in 2014, right?
The ones, they hope to, they wish to. That's ridiculous. Either you have the ability to, hoping or wanting to do something is not what you base your projections on what is actually going to happen. That's kind of ridiculous that they're saying there's 4 million renters that want to buy a home, and this represents pent-up demand. Not if they can't get a mortgage and they don't have the right credit. That represents nothing other than wishful thinking.
Well, and, the interesting part about most of these articles is that they're all pending the fact that, 4 million first-time home buyers want to enter the housing market because of the strong U.S. housing confidence. Really. So what gives confidence is higher prices, right, in a low-interest rate environment. That's fine. But the reality is that you can't even enter into the market unless you have a strong employment base, right?
You're absolutely right, and they have it backwards. The problem with the housing market isn't low inventory, it's low demand because people don't have the jobs or the wages, the income. Not because there's not enough houses for them to buy.
And it's actually...
Because if there weren't enough houses, then the home builders would be building like mad, and they're not. Home construction, new starts, new permits are down for the last 3 months, as are mortgage applications. The demand isn't there because the economy isn't there.
Yeah, but guess what? Congress and the Fed could hang their hat on. There's 4 million first-time home buyers that want to buy houses, but guess what? The economy's doing so well right now, and there's not that much inventory out there. So, they may have to wait to 2015 till after all the snow dries up.
Yeah, it's frustrating to see, as you mentioned. And I have a recent blog post out, I think it was yesterday, who's going to buy the homes to support the housing recovery? But you have this mentality, and I just a couple of quick quotes from the National Public Radio. Here's a quote. And right now, each month, Americans get more jobs. Really? The economy's getting better, so we may well see more homes getting bought. From CNBC, as the housing market moves slowly into recovery, more and more Americans are gaining confidence and hoping to jump into home ownership. Where do they come up with this? Where do they how do they insist that the economy is getting better? Americans are getting more jobs. Well, the recent job reports show there are under 200,000 new jobs created. There were under 100,000 2 months ago. The new jobs aren't being created. And how is the housing market moving into recovery when we saw yesterday that existing home sales dropped to a 19-month low? The only thing that's happening in the housing market is prices are going up. Sales are down, construction is down, and mortgage applications are down. So prices are up on the few homes that they're selling.
Right.
And why does the media insist there's a housing recovery? And there's going to be one, and it's going to continue. Like, we're just entering into this thing as interest rates are rising now.
Right. And most of the increases, as we've noted, have been in the major metropolitan areas, right? So where there is stronger demand, especially investor demand, cash demand. I had a conversation.
But that's gone down too.
Oh, I know that's gone down too. And you actually were you the one that sent me the article that that was talking about BlackRock and a few of the other ones that are starting to pull out?
Yes, that's the article I just cited. I wrote, who will buy the homes to support the housing recovery? It notes that Blackstone has cut its home buying bid by 70% as home prices and mortgages have surged. And then the article also noted that American Homes for Rent, Colony Financial, American Residential Properties have also slowed their house acquisitions significantly. So if they're not buying, how the price is even going to be held up if they've now driven those prices so high, the average consumer can't get a mortgage, can't afford it. Those prices have to come down because you're removing half of the demand almost in the market.
Right. Well,
as the investors leave.
I generally you know that I pretty much hate all these economic reports come out because I feel like they're fixed 90% of the time. They pretty much have them line up where they want, or they don't line up they want, so that it can support the Fed's position. But I usually use an eye test, when I'm just in my own market, just seeing what's going on. And the interesting thing that I've actually noticed is that I have noticed a lot more foreclosures coming to the market lately. Now, not all of these foreclosures are actually hitting like your local MLS, and they're not just the auctions at the courthouse. A lot of these bigger banks and hedge funds, they're using auction sites, online auction portals to sell their properties, and they actually are never going on to the MLS, so you don't even realize it. It's not even a recognized sale. But I was having a conversation with my dad yesterday because I was like, have you noticed that there's a lot more foreclosures lately that we've been seeing around our general Northern Virginia area, which is, a metropolitan area? And he said, he kind of felt the same thing. It's kind of like one of those things where you see it, but you're not really sure if it's actually taking place. But now I've been following it for, 3 or 4 months. It does seem that this is the case. And the interesting part is most of those type of properties, the general public's not going to be able to buy.
Nope.
Because when you go onto the auction site, one of the first things that most of them say is this house is not financeable. Okay? It is not financeable. So that means you are not going to get a loan on it. And the only way that you're going to be able to buy that house is cash or some sort of line of credit or something that you have to potentially buy it. Now, what does that mean? That means that you're going to get that property at probably a discounted rate because no investor is going to pay top dollar. That puts, more pressure on prices downward. But to see that kind of tells me that, things are a little bit more tumultuous than all of these reports are showing, and that, the huge hedge funds that were making these big gambles, I feel like that the reason why they're pulling back is because they know that they might have gambled a little bit too much.
They might have paid too much. And now, I also note in the article that they've got to focus now on renting them out.
Right.
Their models require cash flow because not only do they want to rent them out and make money, but they want to then securitize the income streams from the rentals and sell those to Wall Street. Well, That's more important right now than buying more houses, is getting that done. And they have no experience in this. All these companies, this is a brand new business model for them. Being landlords, they've never done it before, not on this scale. And managed a portfolio of homes, tenants not paying, tenant evictions, figuring out all the formulas as to what percent pay, what percent don't pay, what percent underpay, how quickly can they fill up their vacancies. That's probably a lot harder than they thought, and they probably overpaid for the houses by, bidding them up with cash.
Well, yeah, and I mean, I think that another, we were sticking with that 4 million number that we were using. I don't know where this 4 million number is coming from.
Which 4 million? With the renters?
Well, yeah, there's 4 million renters, right?
But that want to buy a house.
Right, that want to buy a house. But then there's the other article that says that there's 4 million homeowners that are climbing out of negative equity, right? So this 4 million number seems to be the number that they wanted to pull. It's a big enough number to really, to have people really start to buy into that. Oh, looks like this housing market really is, this is the last go around right here, right? So it's saying that if from over the last year, that basically mortgage debt, rising prices and equity levels, about 4 million homeowners around the country last year were able to climb out of the financial tar pit of the housing bust, negative equity. Now, you and I talk all the time. Okay, so let's just say that these homeowners have climbed out of negative equity, as they're stating, Lewis, and let's say that they owed $300,000, right? And last year it was $280,000, but now they're out of negative equity. They're now at $300,000. Now, most people don't fail to realize when you go to sell a home, unless you're selling it for sale by owner, that you're going to have probably anywhere from 6 to 10% right off the top. And
you're effectively still underwater.
You're still underwater. So
if you want to get up and go and be a move-up buyer, it's not going to happen.
Right. So you effectively need another 10% increase in your home price before you're actually out of the water. Right. So those 4 million people that have supposedly gotten their heads above the water, they're really not.
Correct.
And that's one of the reasons also why when we talked, I believe it was a week or two ago, Lewis, about many people were frustrated because they wanted to sell their house first, but were turning to renting their home. Do you know why they were also turning to renting their home? Is because they weren't getting the high number of, or they needed a set number on a sales price to probably break even to get out of that house. And when they weren't achieving it, otherwise it was a short sale. So when they weren't achieving that, they were turning to, okay, well, let me just go rent this property. That might be the quicker fix is to rent it. So all these things line up, and these are more eye tests than anything else. Like I said, the media is not going to push out any of this stuff, but you can pretty much tell on the ground level what's going on. We do have a low inventory, especially in the Northern Virginia, Washington, D.C. metropolitan area. That's going to put, some, upward pressure on prices and send prices higher. It doesn't necessarily mean that the housing market has recovered. When we see that, your big investors, cash investors, are actually slowing down, if not pulling out altogether, and now we have Yellen that's basically throwing out that they could potentially raise federal fund rate 6 months after the taper ends. This is going to put a lot of fear to Wall Street, if you ask me.
Oh, sure, Ryan. If you take those investors out, your inventory issue goes away because now there's more inventory. But as I mentioned in this article, who will buy the homes, you've got four potential groups of buyers, millennials and first-time homebuyers. Okay, we've already spoke about how they're shut out. If they have student loan debt, they're underemployed, unemployed, they're not going to be the source who's going to jump in and save the housing market by buying the homes. Let's go to baby boomers. Aging baby boomers aren't looking to buy new and larger-priced homes. They're looking to sell their homes, move into smaller condos, retirement homes. They're not going to be the basis for any type of new entry into the market to boost the housing market. Move-up buyers, we just talked about. If you got 40% of homeowners either underwater or in a position where it's not economically feasible to sell your house and move up, well, then who's going to, that group can't provide the impetus for further home buying. And then the ones that aren't underwater, many of those are boomers, right? So they're not looking to move up, or they're stuck financing their kids' education or servicing their student loan debts. So they're not really in the position to be the group that's going to buy the homes. Investors we already talked about, they're out. Foreigners, well, you can't really count unless you count on a U.S. takeover of foreigners coming in and buying up the entire housing stock. That's not going to happen. In 2013, they were 6.3% of all home purchasers, which was down 17% from the year before. So foreigners are pulling out of the market. So who do you got left? Nobody. So basically, if you have home sales at a low rate, new home sales, new construction at the historic lows, and now you got investors pulling out, foreigners pulling out, millennials not able to buy, baby boomers not interested, and 40% of people underwater, it's not an inventory problem. It's a demand problem.
Yep.
And that's where I think they won't be able in 6 months to keep calling this a recovery. They're going to have to talk about, and they'll do it, about making it easier for underwater home owners to get above water. They'll try to do something. They'll make it easier for first-time home buyers again to buy a home. They'll do what you suggested. They'll loosen the lending requirements. They'll come up with new products. But the dynamic as it is today, to me, as this exists, home sales will continue to go down and prices will not rise, and that will set in a panic into the policymakers because at all costs they want a housing recovery. Right. And the housing recovery, as far as I can tell, has been in price only, and that's going away now.
Correct. And a recovery in housing would be where we see mortgage applications shooting through the roof right now, right?
And getting accepted.
And the fact that we don't have either one of those things happening, I mean, it's a joke.
Who's the recovery for? Investors? And for people already sitting in their homes? That's not a recovery.
The only people that this housing recovery has been for people that have been flipping houses and actually buying and holding, where they're actually, renting these properties out for cash flow. Those are the only winners here. Now, granted, there's some short-term winners where, there's people that have been in their property and they've seen this, price appreciation, and now they've got some equity in their house. But what typically happens with the majority of those people is they get a little happy that they got equity, and they either, tap into it via a home equity line of credit, and go do some things. So they're actually utilizing that, and they're actually leveraging their house and creating more debt for themselves, or they sell their house. And the only people that are actually, taking that money and doing something with it is actually if you're selling and you turn around and go and rent someplace and you don't dump it back into the next house, right? Because at some point you're going to be taking the equity from one, dumping it into another. So when prices start to reverse themselves, you're going to have lost that money anyway.
Right.
And that's what happened the last go around when we had huge housing boom, was that eventually almost everybody got caught, and the only people that didn't get caught up were the people that had the foresight to see it coming and sold off all their properties and then just continued to rent. But that's
or left at high-priced area and bought in a low-priced area.
Correct.
Like moved from California to Texas. Those are winners too.
But they're few and far between, right?
Most people, right? They buy in their own area or they rent in their own area.
Exactly. Most people, stay within the confines of their own area. They wouldn't, move necessarily out of state or whatnot. But this go around, like I said, even in my surrounding neighborhoods, I see that these, we have a low inventory, houses that are priced right, which is typically, in the middle range. They're not in the luxury category, because as soon as you get back up into the luxury category, you're going to notice once again that it's still a little bit slower. Now, if there's a house that's, just kind of maxed out and got every upgrade known to man in the house, and it shows better than every other house on the block, then yeah, those houses have traditionally always sold faster than every other house, right? It's not gonna matter. That's not because there's a housing recovery that people are buying those houses. Look, the rich get richer. They don't get poorer. They typically pick their spots. They can sit back. They can sit back and wait until they find their home that they want to live in, and they're willing to wait 1, 2, 3, 4 years for it. And you know what? They don't have to even take out a loan. They can pay cash for it and get a loan later for it if they want to. They're not in the position where they have to make a rash decision right away.
Right, and rich investors can also get loans, but they're at lower rates than the mortgages are.
Right, and and the rich have access to capital that others don't. I mean, it's well known that when the rich have huge stock portfolios, they can take out a stock loan to turn around and buy a home. They don't have to be forced to take a mortgage from a bank. They don't have to. They have other options where, the first-time home buyer, their only option is to go and get a mortgage, or outside of that, going to a parent to get them to pony up a huge down payment. And even still, I've seen where that's been the case, where somebody will get a 50% down payment and they'll still get turned down for a loan. Because the banks, once again, don't really have a good reason to lend out money as cheap as it is right now. But if interest rates were to go up, I know everybody's like, well, why would we want that? Well, because the lending guidelines would start to loosen a little bit. They would start to approve more loans. And maybe the banks would actually start to be forced to lend to small business again, which are in my mind, that's a good thing, because it's actually getting the capital back in the common folk versus the people at the top.
Right.
Right? Now, is that going to happen? Probably not. Probably not in the near future. But, I mean, it would actually be refreshing, Lewis, if everything that Yellen's stating, not about the labor market participation rate, improving and all that, but if she actually holds to her, to her guns here and sticks with, we're going to keep pulling back the taper, and we're really going to start raising that federal fund rate come up next year, and she actually does it, I mean, there's something to be said for actually somebody following through with what they say at the Fed.
Everything is done to kind of give you that start and stop. Look at Russia last week. You and I talked last week about the Russian near invasion of Crimea and the annexation, and this was going to be a massive world issue because then the United States was going to impose sanctions. Russia was going to turn around and request only gold or anything but dollars for their payment for their sale of oil, and that was going to set off inflation in the United States, higher interest rates. Well, a week later, here we are. Everything happened as we feared, that Crimea would vote to go with Russia, Russia would take over Crimea, and the United States would launch crippling sanctions and set off kind of this currency war. Well, what happened? Nothing.
Yep.
Russia went in. The vote was 90-some-odd% to be part of, if Crimeans to be part of Russia, not the Ukraine. Russia says, great, thank you very much, we'll take Crimea. And then says, and we're not going to go take over the Ukraine. And the United States says, okay, well, don't go any further, but I'll tell you, we're not going to recognize this. We won't stand for this. And those 8 people in your cabinet, we're going to put sanctions on them.
Right.
Not on Putin, just on the 8, not on Russia, nothing.
Right.
Okay, well, that kind of diffused the whole situation where now the stock market doesn't have to worry about it. Russia's probably not going to do anything. But they have this in their back pocket now that at any point, if they want to say, this will not stand, they can ratchet up the rhetoric again. They've just backed totally away from this. They basically said, don't step over this line. Okay, well, this one. They kept doing it, and Russia said, okay,
right.
fine. And then Russia even preempted the next don't step over this line because they said, okay, thank you, we'll take Crimea, but we're not going to take the Ukraine. So the United States didn't have to say, don't step over this line.
Right.
So basically, that whole dynamic that we were worried about, that's not going to happen now.
Right.
The United States, they put sanctions on individuals. What good is that going to do? They laughed at that.
Right.
However, if at some point, if the United States wants to, and I think one of the reasons they did that was they realized that Russia could, make this about the dollar. And that's what the United States, that's our biggest weapon, is having the dollar as a world reserve currency. So Russia basically, by making that threat, got to take Crimea. It says, okay, we'll still take dollars, not a problem.
Exactly.
But at some point, Ryan, what do you think is going to happen? They're just going to let it sit?
No.
It'll come back into our consciousness.
Well,
or something else. First it was Syria, then it's the Ukraine.
Right. As you and I always talk about, there's always the huge sideshow or distraction or war or anything that can take all the attention off of what's actually taking place on the homeland, right? Always. It always does. It always. But
this one, if they kept it up, was actually going to put pressure back on us if Russia were to follow through on some of those threats, and it would have misfired the creating of the sideshow. So they had to let them have Crimea.
Yeah, and I'm positive that you're exactly right. That's why the president was probably advised, hey, look, we have to be careful how we deal with this, right? Because there could be potential implications with the dollar, and we don't want to, really upset the apple cart right at this point where, we already have enough issues of our own to deal with, right? So,
and Europe certainly didn't want to cause trouble. That's where they get their oil and gas from.
Right. Yeah, so, it is kind of funny how quickly everything's kind of diffused itself. But, at a moment's notice, this could pop back up.
That's what's annoying, right? Isn't it where they tell you something is a vital national security interest and something must be done, and then nothing gets done and then nothing happens, and there you realize, oh, never mind.
Right.
Syria was, if we didn't do anything in Syria, the world was coming to an end. Our security interests were at risk. More people were going to, it was the worst thing that if we didn't act now.
Right.
They're not even talking about it anymore.
No. It's this, it's this fear-based economy, right? I guess you just keep people scared. You know what happened? I
think after the Iraq weapons of mass destruction, I think people are now kind of in tune to that when the leaders come up and say, we must do something because.
Right.
With Cuba, it made sense. They showed the people the pictures of the missiles being loaded in Cuba. That wasn't a fake crisis. And it wasn't the pretext to invade Cuba. It was the pretext to get them to stop putting the missiles in Cuba. See, if that had happened today, they would have shown us the pictures and then launched the attack the next week.
Right. Yeah. Well, it's the same thing with, you would think that everybody would be up on the Fed and how every time they say something, what I really think is going to happen here, Lewis, and I'm sure you might agree with me, is that she's going to remain consistent for as long as she possibly can, right?
Yep.
They'll be able to, continue to push this whole weather issue, and that's why the labor participation and stuff is not exactly where they want it, and that's also the reason we're not seeing the inflation numbers we want. But at some point, she's gonna go right back to, well, as I spoke from when I originally took my post here. I'm going to, make decisions based upon the economic data that I have in front of me, right? And be forced to go back to the old plan.
Yeah, I agree with you, Ryan. The reason they'll do that, when we know when that'll happen is when they realize that they don't have a buyer for the Treasuries and the mortgage-backed securities.
Yeah, well, Lewis, they already know that. They already know that.
No,
right
what I'm saying
now.
is they know that the point is probably they might be able to do one more taper.
Yeah.
And at that point, rates might go over 3%.
Yep.
And if they go over 3%, there's a lot of problems. The 10-year note goes over 3%. And if there isn't a buyer, they'll go even higher. So since the U.S. government isn't slowing down its spending and the Fed buys 70 to 90% of the new issuances and Russia is not buying anymore, maybe not be selling them, but they're not buying them anymore. China doesn't seem to buy them anymore. We saw Belgium stepped up to the plate last month. I doubt that's going to happen every month. So they're going to have to keep it on at least a steady burn and probably have to increase it. Right. Unless they have another plan, as we talked about in our first show of the year, that they actually are going to wind it down and kind of let things go. And that's possible, and let rates go higher and see what happens. I don't think they're that reckless.
I don't either.
I think they're enamored with thinking they can do something.
Right.
Other than just let the chips fall where they may. So, and Yellen's for negative interest rates.
Yeah.
You don't get negative interest rates if rates go higher.
And I think, but see, that could be all part of the master plan, Lewis, is that she comes out, and is saying, hey, we're gonna pull back the taper, we're gonna raise the fund rate because everything's going smoothly. But then she turns into the other Janet Yellen. Right?
The real Janet Yellen.
The real Janet Yellen, the one that wants negative interest rates, and all of a sudden, we tried. Everything looks like it was going in the right direction, but then we had Russia, then we had this, then we had that, so we've had to make these, extreme moves, and these extreme moves are, QE, infinity,
right.
To the second power.
Or something else. Maybe they buy student loan debt,
right?
To help millennials now get them into the marketplace because they don't have student loan debt anymore.
Yeah, if you can't.
Or infrastructure projects, anything.
Well, that's what I honestly feel like that the next election is going to be run on is infrastructure and jobs, right?
Right.
It's got to be what's coming because, they have not, the Fed has proven that what they thought was going to work was going to fix the employment situation.
No, what they told us they thought was going to work. They
exactly.
never thought that.
Well, yeah, they probably never thought it. They had to create a vision of what to push
justify $4 trillion of money printing to the banks.
Exactly. So they have all this going on, but at the end of the day, I feel like she's going to be pushed right back into the same seat that Bernanke was, which is just continue this madness because ultimately,
but not necessarily as QE money printing, but money printing for another reason.
Right, and because as you mentioned, they can't be that. They're probably not going to be that reckless because look, mortgage applications are not increasing. Right, they're not increasing at the interest rate environment that we had, and all this consumer confidence and stuff about the real estate market.
And they're going to increase when the rates go higher.
Right, it's going to start. The consumer confidence will really start to dwindle when they start to see, interest rates are increasing. Oh, now home prices are decreasing. Oh, what is that? The sky is falling. Right.
Yep.
That's typically the way that's going to go down. And the only way that they can prevent that is to keep interest rates low, to keep suppressing them for as long as they possibly can. And like you said, they keep reinvesting money that from the bonds that they've already been, the Treasuries and mortgage-backed securities that they've already been buying. So really the taper is a net loss for them for the most part. And that's
when
why
you say the taper is a net loss, what do you mean the taper is a net loss?
No, a net wash.
Oh, a net wash. Yes.
Yeah, a net wash where basically, they're pulling it back, but they're still reinvesting, the money from the previous buys.
And even at this rate, it's still the same rate as it was at the previous QEs.
Exactly.
It's just that this QE was the largest one. They've just whittled it down to where the other ones were on a monthly basis.
Yeah, and I'm looking and interest rates obviously they've moved up a little bit since she spoke, probably about 0.25%, some 0.3% in some places.
Well, that's a lot, though, on a percentage basis, going from like 2.56 to 2.71.
It is. Yeah, it's quite a bit. And I believe we had jobless claims yesterday, which came in at 320,000 versus 325,000. So there was a little bit of more positive economic news, right?
Oh, yeah, they say that's the lowest since the recession. It's still 320,000 people each week losing their jobs and claiming for it.
It's laughable.
They're trying to say that it means that job hiring is picking up. It signals that. Well, we've seen in the last 2 job reports, jobs didn't increase. The unemployment claims weren't impacted by the weather. We still had 330, 340 a week in the months of December and January, right? But employment went down. They're not an indicator of anything except how many people lose their jobs. Yeah, and when people still lose their jobs, they lose their jobs. Doesn't mean someone gets one because one less person didn't lose one the week before.
Right. Yeah, and so that was negative news, so the rates got a little bit worse because of that. And then also yesterday, existing home sales came out, and the market was expecting 4.6 million. And what number did they get? 4.6 million.
Yeah, but that reflected that's low, though. They've already lowered their expectations.
But see, that none of that language really ever makes it into any of what's put out there, right? Like, it's just that, okay, this was the number that they were expecting, and this is the number that they got. So as long as they get their expected number, regardless of what it's revised downward guidance, right? As long as they can lower their projections, if it's still hitting what the experts say it's going to be, it's okay.
It's a shame because the mainstream media is bought and paid for, and they don't do investigative. They just cite what they're kind of almost told to cite. They just report it as it was expected, and here it is. You really only see the real analysis in the alternative media, the non-paid media, who look at the numbers like we do and try to decipher what they mean and compare them not just to an expectation, but compare them to the numbers of a year ago, or 2 years ago, and say, wait a minute, this is a very low number of existing homes being sold, and we're told we're in a recovery.
Right.
Well, it's obvious you're not in a recovery if you're selling homes at a 2-year low, when 2 years ago homes were at a very low rate because we were in the middle of the recession. So how they can report housing recovery is very masterful, and I think it's just as hypnotic. They say recovery, recovery, recovery. They've been talking about recovery for 5 years. Recovery, as we've mentioned, isn't a permanent state. It's a temporary state between illness and well-being. You're not recovering for 5 years. You're paralyzed.
Right.
At best, if things haven't gotten better.
Right. I mean, we have a labor participation rate, which is nowhere near where it should be. We have existing home sales that are down. We have new home sales that are down. We've got mortgage applications that are down. We've got student loan defaults up.
Home sale, new housing construction down, new permits down. And there's one more. The home ownership rate is down in the last year. Home ownership rate
is down. But you know what, though, Lewis? It's all okay. And I'll tell you why. Because there's 4 million people.
That's right.
Right? There's 4 million new home buyers that want to enter the market this year. And also, there's 4 million people that currently own houses that are no longer underwater. That's
problem solved. There's hopes and dreams and aspirations of people out there, and that's what they're selling. Recovery.
Yeah, you know, it's actually funny because you had mentioned when you sent that article over, and it was you made the comment basically like there's 4 million people that want to buy a home, and there's also how many people that want to make $10 million a year.
Right.
And
I hope to make $10 million next year. Count me in.
Yeah, we all do. But thinking realistically here, those of the 4 million, how many people do you think are actually going to buy a home? Maybe 10% of those.
Well,
maybe.
Whoever can qualify.
Right.
But it doesn't reflect anything other than wishful thinking.
Yeah, and you know what? Our whole economy right now is built on wishful thinking.
Absolutely.
Wishful thinking. I mean, I think that sums it up right there.
Yeah, well, Yellen is the Wizard of Oz, right?
They've made
pull back the curtain, and it's like, well, it's all in your head. If you want to do well, you can do well. I have no special powers.
Yeah, don't worry about what's actually taking place. As long as you believe it, that's what it is. So,
yep. Choose your delusion.
And it's funny because, see, if I were...
But these are economists. They're supposed to be based on hard data, not inventing the data or misinterpreting the data or just pretending certain data doesn't exist or ignoring it.
Yeah, and you bring up a good point. We're non-paid media people. Can you imagine if we went on and the media is actually asking these same questions and we're giving them the answers that we're giving on this podcast?
We would be fired.
We'd be fired, and they would think that we're lunatics, right? They would think that we're absolutely crazy because...
Off the reservation.
Yeah, like, what is he talking about? The Fed, they keep printing all this money and that this is bad for the economy. Look what it's done. Yeah, look what it's done.
Look what it's done.
Yeah, the rich get richer and the poor get poorer.
It's the emperor has new clothes. I mean, if you point out that he doesn't, they look at you and say, of course he does. Look at those pretty buttons and that beautiful crown. And he's naked.
Exactly.
That is a great story because it shows the power that collective thinking has over an individual. And in that story, it's a child who finally he refuses to back down and says, no, he doesn't have any clothes on. Right. I don't see it.
Yeah, so what can people actually do to come back to reality? They can probably listen to our podcast, right? And they'll probably be like,
there's all the answers in there, right?
Yeah, I guess that everything's not as rosy as the picture that I've painted in my head. And I'm not here to say that that everything is terrible because look, I'm just...
Hey, we're fun guys. I'm optimistic about a lot of stuff.
Right, I am too.
But I can't interpret bad news as good news. I can see maybe where the opportunity is in it, but I'm not going to call it good news.
Exactly. But you know what, though? Lewis, when I go and probably sit down with a client today and we're talking about their individual situation, I'm not necessarily giving them, all this bad news based upon a lot of these things like employment. And when they might be in a financial position, that's completely fine, right? They might have a business that's thriving and everything is rosy.
Well, your job is to advise an individual client. The problem with the Fed is they're telling their client, which is the world economy, that everything is fine.
Exactly. Yeah, and the actual data and the eye test that I talk about does not line up with anything that they're saying.
Indicate otherwise. You have exactly right.
But you know what? And this has probably been the case, Lewis, for some 3 or 4 years that we've been talking about this now, right? When it typically, when it smells, there's a reason why it smells. And
we didn't even mention the countless bankers that are jumping out of windows.
Oh, I know. I mean, that's an indicator that things are going well. Not at all.
Yeah. You got a great career. You got a great job as a banker. And you jump in front of trains, jump out of windows. Come on. I mean, it's not like a handful. It's up to like 13, 14, 15 by now in the last 6.
It's up pretty high. And there's been a lot of top executives getting laid off at a lot of these major companies, too. Have you noticed that?
No, I haven't seen that.
Yeah, there's been some executives at some banks and things like that. They're actually, they've just been firing, and I have a feeling that they're looking at the future here, right? They're looking at the future, and everybody knows, including the banks, that that the country itself, on the course in the path that we've taken over the last 5 or so years, is not going to end well.
No, we haven't fixed anything. We've basically tripled down on the problem. It was a debt-based issue. The government grew, and the Fed's balance sheet grew. And one of the points I make in my most recent article is the Fed spent $4 trillion, but in the last 3 years, the GDP growth was $1 trillion. So think about that.
Right.
All this claim of, they grew 2.5, it grew 3%, whatever it grew. Well, imagine if they didn't blow $4 trillion. It wouldn't have grown at all.
Yep.
They didn't even get dollar for dollar GDP growth out of the money that they spent. That's because it went to the banks.
Well, I was about to say, because I wish somebody would give me $4 trillion, Lewis, because I'm sure I could be really productive with that.
Yeah, because if you think about it, if they put it into the economy, if you gave the $4 trillion to each and every individual in the country, your GDP would go up temporarily because people go out and spend it.
Absolutely, but they don't want that, right? They don't want that to happen. They don't want
they want you being rich.
They're worried about it. Yep, that's just for the bankers. That's not for us.
You got a credit tip this week?
This week's credit tip, actually, I'm going to go back to a very simple credit tip, which is basically if you're looking to buy a home, right, and let's say you're a year out, and you assume that you basically just have no credit profile at all, right? I think that what that person needs to do is like a year in advance of even buying, is they need to reach out to, or they can go online, like I said, and you can get annualcreditreport.com. You can get one free credit report a year. But what you actually need to do is you need to go on there, even if you think you have no profile at all, you need to go on there and actually look and see what's on there, because as I normally mention, a lot of the time they can screw up your name, they can screw up your address, they can cross profiles into each other. So even when you said I have only had 4 student loans my entire life, so my credit's got to be great. Mm-hmm. That's not necessarily the case, right? A lot of the times, especially when you have student loans, you could have 3 student loans that then sell themselves to another company, that sell themselves to another company, that sell themselves to another company. And you assume that just by having some student loans that you're going to have good enough credit that you're going to be able to buy a house. Unfortunately, the mortgage lenders were going to require so many different types of accounts. Like, it can't just be student loans most of the time. It's going to have to be like where you have some revolving debt and probably 3 open trade lines, and it can't just be the student loans. So the key thing here is that, especially if you're a first-time home buyer, so we're talking about the 4 million first-time home buyers that are out there today. The good place to start is, you have to have a job for the last 2 years, more than likely. There is some extenuating circumstances if you were in college and you came out and got a job in the same field right away. But the lack of credit profile will prevent you from getting a home. And this is something, like I said, you cannot wait until just 6 months before you want to buy a house. You need to get out in front of it about a year. So if you are coming out, college, wherever, get with somebody, get your report, go to a mortgage lender, come to me, I can push in the right direction to make sure that you establish a credit profile in order to be able to even have a chance to get a mortgage, right? It's pretty simple to get out there and assume that you just have a couple of accounts. But most people, Lewis, have never even looked, especially first-time homebuyers, have not even ever looked at their credit report before going and applying for a mortgage. They just assume that since they've, bought a car, that their credit's okay.
Right.
And it doesn't work that way because, and I said,
cars are notorious. They'll sell to anybody.
They will. They'll sell to anybody.
Hardly any credit. They figure they can always just come back and grab the car and, repo it.
Yeah, so get ahead of the curve on your credit. I'd say a year out is when you should start looking. And actually, better than that, check your credit report every 6 months. And so you can put yourself in a position.
You can do it every month, Ryan. You sign up for those services, they'll send you the report, and you can access it whenever you want.
Every month is great. 6 months is good. I mean, you can always be better, but the majority of people don't even look at it at all.
Right.
So, just get up on that.
It takes time to fix these things.
It does, and a lot more time than people think. So that's why I'm saying just be ahead of the curve on your credit. You can at least put yourself in a better position.
Right.
We're coming up on the end of the show, Lewis. Tell our listeners where they can check out your blog at
Smallgold.com, SMAULGLD.com. There's a blog post there on Federal Reserve, gold, silver, real estate, whatever's going on in the economy, maybe 1 to 3 times a week. And we also post a podcast, the Real Estate 360 podcast on smallgold.com as well.
Perfect. Thank you, Lewis. And thank you guys Ryan. For tuning in. If you have any questions, go to Real Estate 360 Live. Take care.